Since its behavior in both cases was due more to the mechanics of the moving average than to current changes, the indefinite indications should not have been acted upon. But even if they had been, the immediate and correct reversal of positions subsequently called for is evident. Hood's group action. The basic idea of determining market strength or weakness through analysis of its component sections has been carried out from a still different point of view by Oakman Hood. He uses his own price indexes of 37 stock groups such as steels, oils, rubbers, etc., although primarily designed to show which groups are the best buys or sales at any given time. A further refinement of comparative group action has proved an excellent forecasting device. Hood compares his groups with the Dow Jones Industrial Average, that is, whether they are exceeding or failing to keep up with the pace of the latter. Since some groups, like the steels, habitually move more than the average and others, such as the tobaccos, move less, the price change of each group is first adjusted for its normal volatility. Stated briefly, the theory is that if more and more of the groups on an adjusted basis are failing to keep pace with the average, i.e., rising less or declining more, it is a sign of market weakness. Conversely, of course, underlying strength is indicated as a progressively larger number of groups perform better than the average. The reason is that the Dow Jones Industrial Average is not a picture of the whole market, but represents the behavior of 30 well-known investment and speculative favorites. The logic of Hood's assumption will be immediately apparent to anyone familiar with market characteristics. Hood's Group Action 45. It has long been recognized, for example, that the very last stage of a bull market is marked by rather spectacular strength in a few groups and individual stocks, under cover of which the majority of issues are sold or distributed. The top of the market in 1929, for example, is generally taken to have occurred in September, which indeed it did in most of the recognized stock averages. However, the preceding flare-up during the summer actually took place in relatively few stocks, and the majority had seen their highs during the early part of the year when the Dow Jones Industrial Average was some 75 points lower than it was in September. Some 60 of listed issues were declining between March and September, and market averages composed of several hundred issues merely remained stationary. Substantially, the same thing occurred in the early part of 1937. In March, the industrial average exceeded its high of the previous November by about 10 points, but this was due almost entirely to isolated strength in the rubbers, coppers, and steels. Prominence of the last two, incidentally, very often characterizes the tail end of an upward move. In any event, most stocks had seen their highs in November 1936, which the New York Times average does show as the top of that bull market. Unlike the Dow Jones Industrials, it did not rise to a new peak in March 1937. Also note that the whole picture of that major top is much weaker in the Times average, with its three successively lower peaks, as indicated by the circles in Figure 5. It is, therefore, clear that Hood's method provides a clear analysis of such a dangerous situation. Hood has worked out a definite mathematical formula showing the amount of relative group strength or weakness as calculated under his methods, which is required to indicate the probability of a forthcoming important move. Thus, no judgment enters into the determination of a point to act. Details of the formula have not been made public, although it can be said that it requires relatively weak or strong group action, as the case may be, for 4 consecutive weeks. When this occurs, it is called an intermediate signal, because it should indicate a forthcoming move of sufficient duration and extent to be designated as at least an intermediate or secondary market trend. Hood has also applied the same principle to the daily price movement, which naturally results in a greater frequency of indications. These minor signals, however, have been much less accurate than those based on the weekly changes, which have indicated buying or selling on an average of only twice a year. During the last few years, the intermediate signals have been remarkably accurate, and on one occasion at least, called the turn, when a weak position of the market was not particularly apparent otherwise. This was in May 1940, when Germany invaded Holland. Rapidly developing group weakness of a degree sufficient to indicate an important decline was evident by May 11th, when the Dow Jones Industrial Average was still at 145 before dropping to 110. The later development of group strength under Hood's method indicated that repurchases should be made about a month later at 113, which was within 2 or 3 points of the exact bottom. Since group weakness had been developing for about a month, it shows that the invasion of Holland of market did not just burst like a bombshell on the market, but had been foreshadowed by market action. The record of the intermediate signals for 1936-1940 is shown in Figure 6. It is interesting that the buy in January 1937 represented the only time that the same signal was repeated. On the whole, they have been uncannily accurate, so much so, in fact, that it may be wondered whether the same degree of accuracy can be maintained in the future. However, whether or not so precise, the nature of the method is such that at least no signal is likely to be radically wrong. Lowry and Mills, buying power versus selling pressure. The calculations of buying power versus selling pressure, published by the firm of Lowry and Mills, do not represent a new concept or approach, although it is under this name that the method has been most completely worked out. Stated briefly, the Lowry and Mills principle of analyzing the relative strength of buying power versus selling pressure is that the total net daily gains and or losses for all round lot issues traded on the New York Stock Exchange are indicative of the increase or decrease of buying power and or selling pressure in inverse ratio to the volume of trading on which such gains and or losses may be registered. To take an oversimplified example, if it requires 10,000 shares traded to advance a certain stock 2 points, whereas it had formerly risen the same amount on a volume of only 5,000 shares, the rise is meeting more resistance, and hence the situation is that much weaker. To apply such simple reasoning to any and all individual stocks would prove misleading without making allowance for a great many other factors. However, by using all active stocks listed and placing results on a moving average basis, individual distortions are so greatly minimized that they have no appreciable effect upon the total. Anyone could make the Lowry and Mills basic calculations, but it is such a long daily process that it would be extremely impractical. The procedure is to segregate the daily gains and losses measured by closing prices in all stocks, except the inactives, traded in less than 100 share units. The total of the gains is then divided by the total trading volume in the stocks, making up the gains, which represents the average gain per upside share. The same thing is done for the losses, which shows the average loss per downside share. From these, 2 moving average indexes are derived, one being based on the data concerning the gains and called buying power, while selling pressure is the index of the losses and their volume. A much shorter-term moving average index of the plus figures is also calculated, called the short-term measurement of buying power. The index figures are released each day for plotting on a graph prepared by Lowry and Mills, certain levels on which may be used in determining the proper time of action. For example, one of the most certain indications to buy, usually occurring on a selling climax, is a drop in the short-term measurement below 60 on the Lowry and Mills chart, followed either by a rebound of 6 points or the establishment of a zigzag upward trend in the index. See behavior of May-June 1940 in Figure 7. In general, a rising trend to the main buying power index has bullish connotations, while increasing selling pressure has the opposite meaning. There are exceptions, however, as for example, if one index or the other has progressed to such an extreme point that a reversal can be logically expected. Trend lines are employed to a certain extent in determining probable reversals in the indexes. Viewed as anything in the nature of a market operating program or method, the Lowry and Mills analysis may be used in a very simple manner or in a very complicated manner, depending upon the desires and objectives of the user. Lowry and Mills have published quite voluminous discussions on how to interpret the action of the indexes. From the longer-term standpoint, more stress was originally laid on the simple change of balance of buying power versus selling pressure crossing of the two indexes as indicating the proper points of action, that is, to buy when buying power on the way up crossed selling pressure on the way down, and vice versa. The years of 1933 through 1938 showed a good record in this respect, signals having been quite infrequent, only 2 or 3 in each year, and reasonably accurate, the program averaging a gain of about 22 points a year on the long side alone. In 1939, however, if such a program had been followed, there were 11 signals which were rather inaccurate and would have caused a net loss of some 16 points in terms of the Dow Jones Industrial Average if consistently followed. Results of such a plan were again better in 1940, however, indicating sales in May at a loss of 3 or 4 points from earlier purchases, when the Blitzkrieg panic had progressed only 5 of its total fall of 35 points in 11 days. By complicating the above program slightly, that is, by observing buying points only on oversold conditions such as illustrated in Figure 7, and selling only if selling pressure very soon thereafter increases to a new high point, or if such does not occur, selling when selling pressure increases above buying power results may be improved considerably. On such a plan, even 1939 becomes a profit rather than a loss year. Beyond the above steps, viewed as anything in the nature of a program, the Lowry and Mills analysis is rather nebulous, partly because it ordinarily demands considerable interpretation and partly because it can be used in any one of several ways, subject to individual desires. One might, for example, rely primarily on readings of the short-term measurement of buying power alone, and thus get into quite active trading with more room for error. Unless one wishes to operate only in the simplified manner discussed previously, it is far from being a mechanical method. Using the more logical interpretative approach, the evidence required to act may vary considerably in different instances. In any event, there is a logical basis to the theory as a whole, and given some practical experience in studying the action of the indexes, valuable indications are afforded. However, except in the case of a program based on the simplified methods of reading the action points, it seems to be more satisfactory as an adjunct to other approaches than as an absolute method in itself. The Burlingame Plan, designed to protect or increase capital over the longer term by the automatic clinching of profits and the maintenance of cash reserves for buying on a scale down, the Burlingame Plan operates under definite mathematical rules and tables worked out by Warren F. Burlingame. In that sense, it is a strictly mechanical system because it attempts neither to forecast, nor to determine the trend, nor to act on reversals. It is designed simply to take advantage of the fact that stock prices fluctuate. The Burlingame Plan is applied primarily to individual stocks and operates in principle as follows. Suppose that the fund allocated for trading in US steel at 50 a share is 5,000. In other words, one could buy 100 shares. Instead, only 25 shares are purchased at a cost of 1,250. If steel declines 20 to 40, another 1,250 is used, allowing the purchase of 31 shares. Similarly, 39 more shares would be bought on a further 20 decline to 32. If another 20 drop brought the price down to 25, the remaining 1,250 would buy 50 shares. If steel continued to decline, 36 shares, or 1/4 of the total held, would be sold at 20, and the proceeds allocated to the purchase of 48 shares on a still further decline to 15. If this were bought, 157 shares would be held at an average cost of about 31, and these would not be sold until the price showed a fair profit above that figure. Of course, that is an extreme example because no stock is likely to have a perfectly straight decline from 50 to 15. Now, suppose steel had advanced instead of declining after the original 25-share purchase. If it had gone to an order, would have been entered to sell at 56 on stop. This means that if steel declined to 56 from 60, the order would automatically become one to sell at the market. If that did not occur and the stock kept rising, the stop would be raised proportionately along with the advance until a sale was automatically effected. Additional purchases would also be made on the way up, and using the same percentage as on the decline, the other three would be 21 shares at 60, 17 at 72, and 14 at 86. That is what would happen on a straightway advance from 50 to 90. However, unlike purchases made on the way down, each new commitment on the way up is regarded as a unit in itself. That is, the second unit bought at 60 would not use the first unit's stop order at 56, but would be sold on stop at, say, 65, if steel first advanced to 70. If the price went to just above 60 and then began an important decline, the first unit would be sold on stop at 56, while the second unit would become the first quarter of a new purchase plan at 49, 39, etc. It should be understood that the above is merely illustrative. The Burling-Army plan determines the levels at which to buy and sell by mathematical rules and tables based on the historical record of the fluctuation of each stock. These, however, do not remain fixed, because a stock bought at 50 today may have a current calculated next lower buying level of 40, does not mean that the latter will necessarily be the same 6 months from now, even though the purchase price is the same. From this, it is inferred that the past record of fluctuations is placed on some sort of moving average basis, so as to give greater weight to more recent performance. This is only logical, since the fluctuation characteristics of a stock may change. It is clear from the nature of the system that, as a rule, profits during an advance will not be commensurate with the extent of that advance unless it is interrupted by advantageously used reactions. For example, anyone who started to trade in US steel around its low point in 1932 would have made less money at the high of 5 years later than if he had just bought and held the stock. In fact, the gain under the plan amounted to 65 from May 31st, 1932 to December 31st, 1936, while the actual gain in steel was over 200. But one would have lost less in the following bear market of 1937 because commitments would be stopped out at different levels on the decline, or if a start under the plan was made around the top, the cost would be averaged down. On a longer-term basis, the operating results of the Burlingame plan in steel showed the same value in May 1932, when the stock was around 25 as there had been in 1927, when the price was nearly 150 points higher. True, there had been an intervening gain from 1927 to 1929 that was cancelled, but the depression results were far better than just holding a fixed amount throughout the entire decline. These figures on steel are based on data published by the plan and do not assume reinvestment of profits in new commitments. To summarize, anyone adopting the Berlin game plan should be prepared to stick with it for several years, realizing that profits will probably be well below the potential gain in periods of rising prices, but that losses will be minimized during long declining phases. On the basis of the record, it appears that anyone following it consistently will come out ahead in the long run, although it should be noted that the plan must be followed completely. As with the moving average systems, to interpolate judgment at any time would probably be fatal to ultimate success. Natural rhythm. Methods. With what the author has designated as natural rhythm methods, one enters a rather abstract realm where the underlying logic is difficult to prove. It is easy to show why, for example, Hood's group action analysis should detect a weak or a strong market situation, but why these rhythm methods, which come closer to true forecasting than any of the others should seem to work, is a different story. Their proponents explain that just as definite laws govern the various manifestations and workings of nature, so do the same rhythmic laws govern such man-made activities as the rise and fall of civilizations, business cycles, etc. The stock market is merely a convenient place to observe and, incidentally, to utilize the working of these rhythms, because the necessary data are so complete and precise. 99 people out of 100 will no doubt look upon the theory with complete skepticism, for which they can scarcely be blamed. The author is far from sure himself of the extent to which it should be supported, because it involves acceptance of a hypothesis that is very difficult to prove to one's complete satisfaction. The reason for not dismissing it entirely is that the sequences of advances and declines called for in relation to certain times have worked out far more frequently than can be accounted for by the laws of pure chance. In fact, long-term forecasts made on this basis during the last few years have proved startlingly accurate. The general idea, at least, is far from new. For example, there is a chart which was found in an old desk in 1902 by one of the US steel directors, and which is now hung in a New York brokerage office. This was drawn around 1890 and shows the cycles from 1800 to the year 2000. It was apparently compiled on the theory that booms reach their peaks in cycles of 8, 9, and 10 years, and that panics will come in cycles of 16, 18, and 20 years, with some intervening smaller cycles at 7, 9, and 11-year intervals. The 50-year-old forecast has been fairly accurate, although it seems to have been a year early during the last decade, showing 1931 and 1935 as the bottom and top, respectively. The most complete working theory along this line is R.N. Elliott's wave principle, which in brief holds that all stock price trends, whether minor movements or major cycles, are composed of a fixed number of waves or fluctuations, which occur in an ordered sequence or rhythm, but are not of equal extent or duration. This applies to individual stocks, to groups, to commodities, and to averages, since Elliott contends that it represents a natural law which dominates and controls price movements. Unexpected news or sudden events, for example, do no more than affect the amplitude or time of any given wave. According to Elliott, bull markets are composed of 5 primary waves, 3 of which are upward and 2 downward. The upward or advancing waves are always composed of 5 intermediate waves. Each of the 3 intermediate advancing waves is composed of 5 minors. Bear markets and all other corrections between advancing waves, of whatever degree, are composed of 3 waves. For example, if we give numbers in sequence to the 5 waves composing an uptrend, 1, 3, and 5 are up, and each is composed of 5 smaller waves. The downward corrections, 2 and 4, however, are composed of 3 waves instead of 5. For the forecast of probable price levels, the wave principle uses trend channels. That is, by the time 4 waves of any 5-wave trend can be seen, the area in which the whole movement will presumably lie is shown by drawing 2 parallel lines through the top and bottom points. The 5th wave may be expected to reach a new high or low approximately on the line opposite that on which the 4th wave has ended. After the 5th wave, of course, a more important reversal is expected to occur, which will initiate a new trend in the opposite direction. As Elliot has worked it out, there appears to be considerable substance to the principle, and the claim that it represents a natural law is afforded support by certain phenomena in mathematics and nature. The practical difficulty lies in the confusion which is likely to attend identification of the correct waves as they develop. Application of the principle requires considerable study and experience, but Elliot is known to have made quite consistently accurate forecasts on the basis of his studies for several years. Although a very broad indication in the sense that they are presumed to deal primarily with long cycles, the theory of sunspots deserves some attention, if only because of the publicity it has had in recent years. The original idea is more than half a century old. In its modern form, the theory is that since sunspots are accompanied by increased ultraviolet radiation, which produces more vitamin D in human beings and hence indirectly keys them up, there is a logical connection between the coincidence observed of sunspots being at a maximum around the top of business booms and at a minimum around the bottom of depressions. In fact, the correlation has been quite accurate during the last decade, the annual average of sunspots reaching a high at 77 in 1928 and declining to around 4 in 1933, followed by a peak of 112 in 1937. However, traced back for 150 years or so, they have not always coincided so closely with the fluctuations in the economic welfare of mankind. At the same time, there do seem to have been enough correlations to show that they are not the result of pure chance, but there is hardly enough accuracy of timing to employ sunspots alone in dealing with the stock market. Contrary opinion. Approach to get back on more solid ground. The approach used by Humphrey B. Neal in his letters of contrary opinion is worthy of discussion, even though not a method such as most of those previously covered. These letters merely seek to point out what prevalent market opinion may be, and then investigate the reasons for believing that it is likely to be wrong. Indeed, contrary opinion assumes that any very widely held opinion will inevitably prove wrong, and there is considerable truth in that assumption, as anyone familiar with the market knows. Since Neal has had many years of market experience and is the author of Tape Reading and Market Tactics, in which he stressed the study of human nature and market philosophy, it is presumed that his letters of contrary opinion represent a further evolution in his thinking to a point where he regards mass psychology as the element of primary importance in market determination, a view shared by all successful speculators and investors. It should be added that Neal does not issue his occasional letters in any sense as a market advisory or forecasting service. He states that they are simply a means of exchanging informal discussions with a small group of kindred spirits who try to think opposite to the crowd. No advice is intended or attempted in his letters of contrary opinion. The premise is entirely logical, for the composite curve of business activity is fundamentally a curve of mass psychology, which goes to even greater extremes in the stock market. There was never any statistical justification, for example, for the high prices of 1929 or the low prices of 1932. After all, the market is not a mysterious entity in itself. Its price fluctuations result from the actions of a great many human beings, motivated in buying and selling by their own personal knowledge, emotions, and opinions. If it was known just how the public would react to any given market situation, how professional traders would behave, what investment trusts would do, etc., Beating the market would be comparatively easy. As a matter of fact, all so-called technical study is really directed at discovering this very thing, only it is usually called determining supply and demand. But just as financial commentators talk about the market doing something or other, so does the technical field obscure the real issue with its jargon of resistance levels, triangles, oscillators, etc. Actually, it is just an attempt to analyze the changes that are taking place in the activities of the thousands of individuals whose collective action makes all the price movements of the market. All other things being equal, a good psychologist should come out better than an economist, in trading activities at least, by applying his training to the determination of the probable reactions of other groups. That is undoubtedly the conscious or unconscious basis of all who have achieved outstanding success as individual market operators. Bernard Baruch has remarked that he frequently rereads Mackay's memoirs of extraordinary popular delusions and the madness of crowds, and Gustave Le Bon's classic study of the popular mind, the crowd. Every successful speculator and every student of psychology knows that the mass of people are less intelligent than the few. It is said that only 5 of the population think for themselves, 10 copy the 5, and 85 believe what they hear and read and do what they are told. Since there are many thousands interested in the stock market, it is reasonable to assume that they are a fairly representative cross-section of the public. Therefore, if the majority are less capable than the few in all things, this must hold true likewise with their market behavior. The implied idea of coppering the bets of the crowd is not a mere theory, because it is obviously just what successful investors or speculators do. As everyone knows, the public is most bullish around tops, as in 1929 or 1937, and yet those are exactly the times when, to be successful, one must be selling. In order that a few may be right, the many must be wrong. Thomas F. Woodlock voiced this eternal truism some years ago when he said that the principles of successful stock speculation are based on the supposition that people will continue in the future to make the same mistakes that they have in the past. One individual, who both made and kept a large fortune, remarked that his success lay merely in doing what other people wanted him to do. When they clamored for buyers, he accommodated them by buying, and when they were anxious to buy stocks at high prices, he agreeably permitted them to buy his. It is indeed a natural law that the majority must be wrong and can make money on paper only while the trend of prices is upward. A moment's reflection will show that this must be so. Suppose everyone decided at once that it was time to sell stocks at the prevailing price level. In that case, there would be no one to buy. If one half should sell to the other half, then subsequent events must put more wealth into the hands of one group than the other. What actually happens is that more wealth gravitates into the hands of the few, while the many have less. Ask yourself how many people you know who have really made a net profit in the market over, say, the last 5 years or 10 years. If you know of any, do you not know several times their number who have lost? Or, put the question to your broker who sees a good cross-section of accounts. Does it not follow that, if the majority lose, it is necessary to think and do the opposite of what your neighbors are thinking and doing over a period of time? Certainly, everyone seems to make money in a 1928 or a 1936, but as far as the majority are concerned, the profits remain on paper and eventually turn into at least semi-permanent losses. Returning to Neil's theory of contrary opinion, however, it is clear that as a matter of practical application, it cannot be consistently used at all times, which has always been the difficulty in trying to go opposite to the crowd. The crowd may seem to be right for a time, as, for example, in 1928. Secondly, it is necessary to be sure what the crowd is really doing. From Neil's standpoint, there is often no general opinion sufficiently crystallized to feel justified in taking the apparently opposite view. There is one large investment trust which attempts to sound out sentiment scientifically by sending questionnaires to brokerage houses. But although this may give them a good composite of street feeling, it can hardly be a complete cross-section of prevailing market opinion. Perhaps a Gallup poll would be the best solution. On the other hand, there are unquestionably junctures when a certain view of the probabilities is so universal that it can safely be crossed. There was such a situation in the spring of 1938 when everyone seemed to be convinced that stock prices must be lower by summer. It was a bear market only a year old, according to the Dow theory. Business was at a low ebb. A pickup would normally await the seasonal stimulus of the fall, and stocks were not particularly cheap. To adduce any apparently logical bullish arguments was extremely difficult, as indeed it always is at such times. Quite naturally, all those who expected lower prices in the summer were selling stocks, thus actually creating the bottom, perhaps, ahead of the anticipated schedule. In any event, what actually occurred was one of the sharpest market advances on record in June, coming out of a clear sky and without the benefit of any unexpected news whatever. The reactions to war, prospective and actual, were an extremely marked example of contrary opinion. For a year or two before the outbreak of conflict in September 1939, the market had habitually declined on war scares. But when war came, the result was a sensational rise which germinated a belief in the public mind that intensification of the conflict later would stimulate a rise in stock prices. When the invasion of Norway came in April 1940, however, it marked the last gasp of a minor advance, which was generally expected to continue into new high ground on the theory that more war activity meant more war orders from abroad. Similarly, when Germany overran the Netherlands a little later, the opposite of September 1939 occurred, and instead of prices rising, there was a break of complete panic proportions. In October 1940, Neil mentioned the widespread belief that if Willkie were elected, the market would have a substantial advance, while the re-election of President Roosevelt was supposed to have the opposite effect. Naturally, he looked for contrary price behavior. No one can prove what might have happened if Willkie had won, although the chances are that Neil would have been right, because if Wall Street had expected a Republican victory, which it did not, the street's betting odds remaining consistently on Roosevelt stocks would have been bid up before the election and then sold after the news was out. The fact that the market advanced briefly but sharply after the election, when the reverse had been expected, is merely an informative example of contrary minor swing fluctuations. One danger in contrary thinking lies in its loose application. That is, although the process may be entirely unconscious, many people simply try to rationalize their previous beliefs by seeking contrary opinions to support their position in the market or their preconceived plans. 66. The odd lot indexes. This method really belongs with the group determining the character of the market, but the section is placed here because it should be read in conjunction with the immediately preceding discussion. The difficulty has been mentioned in connection with being contrary, of ascertaining true public feeling merely by reading, listening, and generally sounding out opinion. It is the author's contention, however, that changes in the market sentiment of the public, and also that of the professional traders, can be statistically measured with reasonable accuracy through the figures released by the Securities Exchange Commission on odd lot trading and the operations of New York Stock Exchange members. These data are a fairly recent innovation and, for the first time in stock exchange history, afford definite information on the question of who is doing what. Odd lots are the less than 100 share units of stock traded which do not customarily appear on the tape. The data on each day's odd lot purchases and sales are available since June 1935, although there is a gap between December 1935 and March 1936. Since June 1937, information on the number of odd lot orders to buy and to sell has been given out. In June 1939, odd lot short sales, both shares and orders, became available. At the same time, data were made public on all short sales and the short sales of New York Stock Exchange members, in addition to the regular sales and purchases of the latter, which had been published since the latter part of 1936. It may be remarked here, however, that the data on the member transactions comes too late to be of much practical use, but as will be shown, it is not as necessary as it might seem. Until September 1940, the member figures were 3 weeks late, and there is still a 2-week lag. On the other hand, the time of the odd lot transaction releases has been cut down until the figures for one day appear before the market close of the succeeding day. One assumption in the use of the odd lot figures is that they represent a cross-section of what the public is doing. In fact, the author has calculated that nearly 1/3 of the public's dealings are in odd lots. Similarly, New York Stock Exchange members account for a slightly larger proportion of what may be called professional operations. Quite naturally, the public and the professionals are ordinarily on opposite sides of the market, a fact rather easily proved by close analysis of odd lot trading as compared with that of members. That is why the time lag in the member figures is not particularly important. One can be reasonably certain that they will show just the opposite tendencies from those revealed by the odd lot data. The author uses 4 indexes derived from the odd lot data to determine what the public is doing and hence, subject to certain conditions, to ascertain the correct opposite course. The first is a 10-day moving average of the ratio of odd lot sales to purchases, called the balance index. See Figure 8. Thus, if this index rises, it means that the public is buying less or selling more than it has been, and vice versa. The second is a 5-day moving average of the ratio of odd lot short sales to all odd lot sales short index. Similarly, if this index rises, it means that the odd lot public is growing more bearish and believes prices will go down, since it's always small short sales averaging only 2 or 3% of all its sales are increasing. Incidentally, it has been found that New York Stock Exchange members account for about 70 of all short sales made, while only about 8 are in odd lots. The third index is a 5-day moving average of the ratio of all odd lot trading purchases and sales to the doubled trading volume index. Contrary to what might be expected, this is low at tops and high at bottoms. The fourth index is also a 5-day moving average ratio order index, using the size of the average odd lot sell order in relation to that of the average buy order, these latter figures being obtained by dividing the shares bought or sold by the respective number of orders placed. In effect, what this does is to show whether odd lot trading is concentrated in high or low price stocks, since the size of orders is naturally an inverse ratio to the price of the stocks dealt in. Concentration of public trading in low-priced issues is often an indication of a top or a vulnerable market situation. The direction in which all 4 indexes may move has the same significance, which is the reason for using the particular mechanics described. If all 4 decline, it means that the public is becoming more bullish, and hence one should be bearish. If they rise, one should be bullish. It makes little difference whether the odd lot public is actually buying or selling on balance. The significant considerations lie in the shifts of sentiment, which may be shown simply by less selling, for example, in place of heavy selling. Thus, the odd lot public primarily sold the 1932-1937 bull market until November 1936, which, as pointed out before, was the real top. Finally certain that the market must continue to rise merely because it had been doing so, The public regarded the big declines of 1937 as bargain opportunities. Disillusioned as to that later, the early advances of 1938 to be later exceeded were taken as opportunities to sell. Perhaps the most curiously revealing feature of public psychology, as shown by the odd lot figures, is the normal tendency to sell rallies and buy declines. But although this general principle is correct, its ill-timed application by the odd lot public makes the latter wrong in practice. That is, this public may sell rather heavily as any given advance progresses, but as it approaches the top, the selling is likely to diminish, or it may change to actual buying. The opposite, of course, is true on declines, and it is in these changes of speculative sentiment that the public may be said to be almost invariably wrong. Odd lot trading is very definitely speculative, and investment buying or selling represents a very small proportion of the odd lot figures. In fact, an exhaustive investigation by the Brookings Institution disclosed the rather startling fact that 80 to 95% of all odd lot trades are turned over within 1 month. The ratio of sales to purchases index shows whether the odd lot public is pursuing its first normal tendency or not. When doing so, i.e., tending to sell a rally or buy a decline, this index moves parallel to the market trend and has no significance. When the behavior changes, it diverges from the market trend and can then be taken as a signal to act, particularly if confirmed by the other 3 indexes. The author also uses the same indexes on a weekly and monthly basis because the tendencies of the public on short swings also appear on the longer-term trends. Through the private study made by the Brookings Institution, the odd lot shares bought and sold are available on a monthly basis back to 1920. It is a rather curious fact that they do not show the public becoming really bullish until early 1929, although everybody is supposed to have been speculating a year or 2 before that. Similarly, although the little fellow is generally believed to have been more or less wiped out in the 1929 crash, the odd lot figures show the normal disposition to regard the break as an opportunity for bargains. In fact, more shares were bought than sold in odd lots all the way down to the bottom in 1932, but during the last part of the decline from September 1931 to June 1932, the buying diminished, thus producing an upturn in the monthly index, diverging from the downward trend of stock prices and indicating the last phase of the bear market. The same phenomenon had appeared at the bottom of the 1921 bear market and showed up again in the spring of 1938 when the major downtrend from 1937 was ending. Its reverse had been seen during the end of the bull market from late 1936 to early 1937, i.e., the monthly index declined while the market rose. Just as a bear market bottom is marked by progressively smaller odd lot buying for several months while prices are still going down, so is an intermediate selling climax identified by the same tendency in terms of days instead of months. With 2 exceptions in recent years, the low point has occurred about 6 days after the ratio of sales to purchases index had turned up while the market continued to fall. Note the climax of this nature in Figure 8 on the war scare decline of 1939. Such a short-time element for divergent trends holds good only in the case of a climactic decline. Ordinarily, 2 weeks or more are allowed for them to become established. A clear-cut picture on these odd lot indexes has never been radically wrong, although occasionally a successive sale and purchase or purchase and sale has not gained anything. And in 1938, which was the most difficult year on the whole, one 4-point loss would have been involved. Moreover, before the important tops of March and August 1937, the sales indicated by the odd lot indexes were premature and therefore appeared wrong for a time. In January 1937, A very definite selling indication showed up when the Dow Jones Industrial Average was about 184. Prices, however, continued to rise for nearly 2 months until the average reached 195 in early March. But the picture of the indexes merely continued to grow in bearishness. Similarly, one could not mistake the sell, which appeared in July after the average had risen from 165 to 178. However, the rise continued for a few weeks longer to 190 in August, but again the indexes deteriorated further. It is interesting, however, to recall that on both of these occasions, the market as a whole was not so strong as it appeared from the industrial average. See Figure 5 on page 44. This approach to the market through an analysis of what representative groups are doing is psychological rather than technical. Except as intuitive reasoning may have been applied before, it is entirely new because the data on which it is based were not previously available. Moreover, the basis is a logical constant, since the human mind is the one element in speculation that is always fixed and will never change. Viewed as a method, the odd lot indexes have the disadvantage of requiring a certain amount of interpretation at times, which merely means that one requires a good background of familiarity with their behavior. This is being dealt with more extensively in another scheduled publication. The indexes will detect changes in trend with remarkable accuracy, but cannot predict the duration and extent of the subsequent advance or decline, except as the longer-term, weekly and monthly figures will, at some junctures, reveal the basic strength or vulnerability of the market. At a time like early 1937, for example, the latter would show that any temporary top indicated by the daily indexes could be the final one, and hence might be followed by a very severe fall. The converse, of course, would be true around a bear market bottom. The buying and selling indications of the odd lot indexes for the period of 1936 to 1940 are shown in Figure 9. Naturally, it has been necessary to assume probable action in the earlier years. To what extent the latter might have been modified by the data which became available later on odd lot orders and short sales is impossible to say, but it seems doubtful whether they would make any material difference. Section 5. Some conclusions: market timing versus stock selection. The trail of forecasting has been well blazed since the early crude attempts, and it is safe to say that no possible avenue of approach has been neglected. Unless the result of new information becoming available, as in the case of the author's odd lot indexes, no really original methods are likely to appear. Most of those which appear at first glance to be new turn out to be merely variants of some method described here. The ideas that are actually new somehow do not seem to meet the application of rigid tests. In fact, the forecasting cycle is apparently just about complete. From having nothing to speak of 40 years ago, there is now almost everything. Yet although there never will be a perfect method, the cycle is also complete in another sense. That is, there is one school of investment thought today which holds that it is impossible to forecast with even a reasonable degree of accuracy, and therefore neatly solves the problem by confining its purchases to growth stocks, on the comfortable theory that, whatever happens to them temporarily in declining markets, they will always go ahead to new highs afterward. Growth stocks are the equities of companies whose earnings have demonstrated underlying long-term growth and give indications of continued secular growth in the future. There are obvious advantages in the theory of growth stock investment, but there are still plenty of risks in that some unforeseen element may change the growth factor, or so great a premium may be paid for it that the anticipated new highs do not materialize, to say nothing of the fact that an extreme depression like 1932 would temporarily at least make the picture look extremely sick indeed. The growth stocks of the last decade sold higher in 1936 or 1939 than they did in 1929, but how many of them could have been selected in 1928 or 1930? Moreover, it might have been 6 or 7 years before the investor in growth stocks saw daylight on his purchases, and at one point he would have suffered a very substantial paper depreciation. Thus, even granting that mistakes will be made in dealing with the price swings, it is certainly questionable whether there is not just as much room for error in attempting to pick growth stocks at the right times. They are seldom outstandingly attractive by the time their growth qualities are widely recognized. This school of thought is probably quite right in its assumption that there is no dependable way to forecast the stock market, if by forecast is meant the ability to predict the beginning, the duration, and the extent of price swings, either major or intermediate, with even reasonable accuracy. But as the obvious logic and indisputable record of some of the methods described here show, it is certainly not impossible to deal with stock fluctuations so as to have even more than a reasonable assurance of profits, just so long as the market does not go completely dead for years on end. The real difficulty is that, human nature being what it is, investors are inclined to expect the impossible from forecasting and forecasters, and lack the patience required to follow consistently any of the surer methods outlined here. They always feel that this time something new and unexpected has happened, and hence that they are justified in ignoring the rules and doing what their own or someone else's judgment, in reality, usually emotion, tells them to do. One of the greatest single causes of loss is the proneness to take important action on the basis of transient news of the day or trivial market indications. The average person is his own worst enemy in the stock market because he is too easily swayed by hope, fear, or greed based on insecure grounds. Perhaps the strongest argument for almost any logical system is that once the decision is made to stick to it, 90 of the worry and strain to which most people subject themselves is eliminated. Long, worrying declines occurring without apparent reason until near the bottom are avoided, and one is not driven to wonder what effect this or that piece of news will have on the market. There are many other advantages, and if the system is not perfect, the chances are 100 to 1 that its timing of purchases and sales will be infinitely superior in the long run to those chosen, because Hitler is preparing to invade England, Roosevelt is encouraging labor, the market looked strong last week, etc., etc. Even the strongest proponents of the individual stock analysis approach, who decry technical market timing, say that purchases should only be made when the general price level is low, and then sold when the level is high, as judged by objective standards, something that is likely to result in very poor timing indeed. How high is high? Stocks seemed irrationally high in 1927 to experienced investors, but during the next 2 years they went much higher. Similarly, they seemed low in 1931, but they later sold at 1/3 their average price of that year. A well-known investment trust, whose policy is primarily that of long-term investment in growth stocks, admits privately that it would liquidate its whole portfolio if convinced that a major bull market top was at hand, although the chances are that it will never feel sufficiently convinced. In other words, good timing is universally desired as far as the broad swings of stock prices are concerned, but because of the supposed greater difficulty and risk, good timing on the shorter-term moves is ignored as being a will-o'-the-wisp. In the author's opinion, this involves a fallacy. An intermediate top or bottom, for example, may be far clearer than a major turning point, while what appears to be at the time only a temporary change of trend may also turn out to have been the last chance on a much more important reversal. Many long pull investors ignore signs of a change in trend because they feel it is temporary. Often, of course, they are quite right, but eventually they are likely to be seriously wrong. The fact that action may be first taken on a short-term basis does not necessarily mean that the position will be shortly reversed. That will only be so if the method used indicates such a step, which may or may not be the case. For instance, look at the intermediate signals of Hood's group action in 1937, page 47. After the first sell early in the year, it happened that repurchases were indicated shortly thereafter at a somewhat lower level. Now, when sales were again indicated August, one could not know whether the sequence would be the same or not. There was nothing to say that this time the ensuing decline would be one of the worst in history and that one would remain out of the market until well into the next year on the basis of group action. That is why even character of the market methods do not really forecast. They may detect turning points with reasonable accuracy, but it is asking too much of any method to expect that it will likewise predict the extent and duration of the new trend. Realizing then that no approach can be expected to function as a complete predictor of when, how much, and how long, but can only perform within known limitations, the following may be set down as attributes of the ideal method. 1. A logical basis for its working, i.e., some reason other than just having worked in the past. 2. A basis that cannot be altered by changed conditions. 3. A good record in both bull and bear markets, also in periods of erratic movements as well as consistent trends. 4. The realization of large profits when large profits are possible and, under any circumstances, no large losses. 5. Definiteness of indications, subject to little interpretation. 6. Characteristic buying on weakness and selling on strength. 7. Capacity to indicate the probable extent of any forthcoming move. It is extremely difficult for any one method to meet these qualifications. For instance, the second requirement virtually eliminates all fundamental methods, since something can always happen to change whatever relationship they may have had to the market in the past. Therefore, it must be concluded that the ideal method is technical, that is, based upon something closely connected with the action of the market itself. All of the trend systems in Section 2, as well as the Parker method, have no forecasting qualities at all, and hence do not meet the requirements enumerated. Neither do the trend systems actually sell on strength and buy on weakness. They do so only to the extent that they act near the beginning of a move, if it proves to be long, but only after that move has started. By their nature, they cannot indicate buying on the bottom of a selling climax or selling on a peak blow-off. This is not utterly to condemn the use of such methods, because they do have the advantages of completely definite signals and simplicity of operation. It is merely important that the user of trend methods understands what they will and will not do, that he elects to follow just one procedure, that he acts consistently on every indication given, and that if the market runs into a protracted sidewise period, he must expect a series of losses with only the consolation of knowing his position will be right when the big move does come along. The price paid for such assurance is represented by the small losses during the times of small fluctuations. Selling signals should logically be acted upon with short sales as well as liquidation of the previous long position. This is because an indication to sell has just as much chance of being right as one to buy, and losses are always automatically limited by the method itself if the price trend does reverse its anticipated direction. The basis of selecting just which one to follow depends less perhaps upon its merits in the past than upon the degree of activity desired. Obviously, the technometer, working on a 4-day basis, will give more frequent indications than the semaphore, operating with a time element of several weeks. It is emphasized, however, that only one should be used. It does not gain anything to use, say, 3, with the idea that if all give the same indication, the result is more likely to be profitable. Their actual forecasting quality is nil, and 3 times nothing is nothing. It is psychologically difficult to follow any of these methods as consistently as they must be followed. For one thing, it is hard to take the losses they often call for, perhaps several in a row, even though these will never be staggeringly large. It is also difficult to forget or disregard the top and bottom prices, which these methods will almost never catch, because they are designed only to act on an apparently established trend. Thus, if used, it should be kept in mind that over the long run, the final result will be a moderate net profit. The only possible way they can fail is if the market should remain for years in the same narrow range with scarcely any important moves. For anyone who wants a simple and fairly active mechanical system in the following the trend category, R.K. Parker's method seems likely to prove most satisfactory on the basis of comparative results at different times with other devices operating in essentially the same manner. Note from figures 2 and 4, for example, that whereas the technometer lost 13 points on Chrysler in 7 moves during the sidewise market of May and June 1939, the Parker method had only 3 moves, which would have meant a much smaller loss of 434 points in the same stock. Going back to the attributes of the ideal method, it is found that, as a rule, several of those which attempt to determine reversal points by analyzing the character of the market fall down on just the opposite score from those concerned with determining the trend. That is, so much interpretation is required that there is always the danger of being swayed at any given time by personal considerations, emotions, or strongly preconceived ideas to the detriment of the necessarily impartial interpretation needed. Even the Dow theory comes within this category in its usual interpretative application, although, as pointed out, Moment's rules afford an opportunity to use it mechanistically. Because of their simplicity and definiteness, Moment's major trend rules seem ideal for the investor who, realizing the limitations, is willing to look for his rewards over a long span and is prepared to go for perhaps 2 or 3 years without making any move whatsoever. However, most people want to keep more of a finger on the market's pulse than these systems allow and prefer something more in line with the ideal method that does have at least a certain quality of forecast. All things considered, Hood's group action and the odd lot indexes come closest to fulfilling the requirements laid down. Both work on the basis of the market as a whole and, unlike the moving average systems, cannot be applied to individual stocks. They determine the strength or weakness of the whole structure, which, after all, is all that one really needs to know. The selection of individual stocks as media is a relatively easy matter, since all that is necessary is a reasonably diversified group of market leaders, which, on the average at least, are certain to follow the general trend. One can be sure that if the market is going up, US Steel and General Electric will not be going down. There is always a certain danger in thinking too much in terms of individual stocks or specialties, because then one is likely not to see the woods for the trees, which may be fatal on important changes of trend. These two methods have a logical basis and are able to detect signs of approaching weakness as the market rises to a top, or signs of gathering strength as a bottom is approached. They have some degree of forecasting ability in that one always knows ahead of time when a buying or selling indication is possible or probable, whether or not it actually materializes. Hood's group action is entirely definite if used on the basis of the intermediate signals, because these are calculated by a mathematical formula, whereas there is more interpretation involved with the odd lot indexes. Although signals have often coincided, as may be seen by comparing figures 6 and 9, It is important to note that the two methods operate on an entirely different time element, and that group action is only concerned with the larger price swings. For example, the odd-lot indexes showed very distinctly weakened market situations in September 1939, around the top of the war rise, and also at the top in early January 1940. During all this period, Hood's method on an intermediate basis remained, with its holdings purchased much lower in April 1939. All other things being equal, the fewer methods one tries to follow, the better, and the simplicity of the completely mechanical systems is one of their greatest advantages. In fact, simplicity or singleness of approach is a greatly underrated factor of market success. As soon as the attempt is made to watch a multiplicity of factors, even though each has some element to justify it, one is only too likely to become lost in a maze of contradictory implications at any given time. That is one of the pitfalls of either generalized technical or fundamental study. The various factors involved may be so conflicting or confusing that the conclusion finally drawn is no better than snap judgment would have been. It has been pointed out that any trend method, if employed at all, must be used by itself. The same is true of such systems as R.K. Parker's index or the Burlingame plan. On the other hand, the approach is primarily concerned with determining the character of the market, such as the group mentioned on page 14 may logically be used in at least partial conjunction. But sticking to one or two specific methods, even in this group, is likely to yield better results in the end. And remember that in the marketplace, patience is an even rarer jewel than judgment. During the past year, the author has been asked by many well-meaning friends why he should publish a book on stock market profits at a time when there are no profits, when the financial business is supposed to be just waiting for the knockout punch, when the public is apathetic even to good stocks yielding 7 or 8, when there is visualized nothing ahead but a long vista of more tightly controlled economy that will choke off all free enterprise, and with it the stock exchange, which is the nerve center of the whole system. Certainly fewer people will be interested in anything pertaining to the market than would be at a time when prices had been rising for a year or more and the volume of trading was high. The tape is its own best advertisement, but it is too much to hope, or indeed to expect, that things can ever be any different from this viewpoint. It is simply normal crowd psychology to reflect conditions as they are, and to believe that because they have been, they must continue to be. Once an idea becomes firmly fixed in the mass mind, it persists for a long time and is not eradicated until the new conditions at first regarded with complete skepticism have lasted for so long that they cannot be denied. The deliberate stock manipulations of the past, for example, were predicated upon this simple fact, the technique being to put the price up and then sell on the way down. If a stock has been around 20 for a long time and is then bid up to 35, many holders are willing to sell and few new investors are willing to buy because the price looks high in relation to that which they have been accustomed to seeing. The same feeling persists on a further advance to, let us say, 50, although they are now looking for reactions on which to buy. The fact that it had been 20 is beginning to be forgotten. And when the price is 40, they only wish it would come back to 30 so that they could get in on this splendid advance. Finally, after reaching the peak, the stock becomes a bargain at 45 and even more of an opportunity at 35 on the way down again. For was it not selling at 50 just a little while ago? The same price of 35 that looked high on the way up in relation to the original level now looks low in relation to the top. Note how this behaviorism is borne out by the odd lot buying and selling as discussed in section 4. Now, the same principles apply with equal force to less concrete situations. It is unquestionably true that at the present time, The speculative interest of capital is at its lowest ebb for the entire period since World War I, although the heavy downtrend has been since 1929, relieved only temporarily between 1935 and 1937. Physical production is at a record peak, but stocks are selling at 1/3 of their 1929 high prices. A seat on the New York Stock Exchange can be bought for about 1/20th of what it cost during the climax of what was once fondly referred to as the New Era, and at the lowest price since 1898, when only 1/3 as many issues were listed.